Well, show. Sorry, I'm a few minutes late. I was going to set up actually in where I normally set up in my office downstairs, and then it occurred to me that the door had been closed and the crypto rig was running hot and the windows were closed, so it was just unbearable. Went to set up down there and it was unbearable. So we're upstairs. Normally I'm in the basement and the walkout. We're actually upstairs right now and we're in my guest room. So let me know if you guys can hear me loud and clear. Today, I'm going to talk about something that I didn't know if I was going to share it on here or not, but I decided I'm going to share it. We accidentally stumbled upon our dream house, and you guys know, what was it? 2 years ago, I bought the house that we're in now. So yeah, just about 2 years ago, bought the house that we're in now. And I love this house. It does have some drawbacks. It's not a huge lot. We're in a subdivision with other great $1 million homes too and stuff. It's awesome, but and it's crazy because I bought my house for 665, and it's worth probably 1.2 right now, and I'm gonna have to sell it now and put it on the market and whatever. I didn't think I was gonna move for a long time, but we came across the dream house, and I couldn't resist. This property's over an acre in a better location, closer to the schools, closer to amenities and walking distance. It's like country in the city. The main house has the house hacking built in. It's got the potential for the office. It's, we're talking, it's got a guest house, currently has 5-car garage, going to do an addition and put a ideally 7-car garage with a beautiful piece of property, indoor pool, just every amenity you can think of, a beautiful waterfall that I can wake up to and see. It has the potential, and I'm a sucker for potential. I like to buy things that are diamonds in the rough and then improve on them, right? So that's something that I'm super excited about. So we'll talk about that a little bit today and share with you guys what's been going on with that. And I'm just super excited for it to be over 10,000 square feet, including garages. That'll be basically, I think it's our dream home. I don't think I can find another opportunity better than this one. So super, super excited for that. And the other thing I wanted to talk about was, you guys know, my wife's 40 and a half weeks pregnant, or she was. We went through, I guess, was it Monday night at 3:30 in the morning, where we tried to do a home birth, but that was unsuccessful. We had to go to the hospital, and the birth of my third daughter. So her name, baby Rosie. So excited about that as well. And so this week's been tons of excitement. Literally, like within 48 hours, I had the birth of my third child, and we found a dream house compound. So super excited to share those things with you guys. And so there's actually a picture of the parcel there in the thumbnail, so you get a little view. Check that out. Not just clickbait. So here we are. If you guys have any questions, by the way, shoot them in the comments below. I don't know. It feels surreal to be in a position where I can sort of lux fire, and I know someone's gonna ask what did I pay for it, and I'd be happy to share that. Just a little bit over 1.3 million for it, which is a steal. I think the after renovated value of it is going to be about 2.5 million. So it should be a triple burr, so to speak. So I'm really, really excited for the opportunity and the potential in this new purchase. And, if you guys follow, in Canada, your primary residence, if you stay there for, I don't really care because I don't plan to sell this next one, but if you stay there for a couple of years, it's tax-free. And so if you buy smart on your primary residence, it can be a fantastic investment vehicle, specifically from a tax savings perspective. So I always try to find deals on the houses that I buy, or try to find an angle where I know that I can sell this to someone down the line, and I have an exit strategy in case things go south. That's just the way that whenever I invest in, I'm always looking at what is the downside and how do I minimize or mitigate that downside risk. And so it is a house hack. It does have a couple of suites in it that'll more than help offset the carrying costs, as well as this is the crown jewel of this property, 460 amps, over 600 volts. This thing could power a school. It's got a lot of power, which is fantastic if you're interested in crypto or you want to do some cool things with all of the hydro capacity in this property. Super excited about that as well. I think that in the future, a lot of us will just have little crypto rigs that we use to offset some of our living costs. I think that's something that long term is going to become much more, something that much more people are going to jump onto. Even it won't be paying out the same that it does now, but I think that it'll be a great opportunity for people to house hack their basements by plugging in some crypto rigs. And even if you factor in depreciation, I think that there'll be a good long-term prospect with that too. So that's something I might explore, I might not. We'll see. As you guys can see, the bag's gonna rise with the add of the third and the dog. It's basically having 4 kids in the house, and it is tiring. I've not gotten great sleep, so I am quite sleep deprived right now. Any questions I answer for you guys may or may not be fully thought through. So keep that in mind when you ask the questions today. But thanks so much, guys. Congratulations. I appreciate all the messages here. Greetings. Congratulations. Thank you. Thank you. Congrats on the birth. Thank you. Things are going very, very well, and I'm super pleased with everything. And I'm sure I'll do some future videos on how I'm able to house hack within, sort of a mansion compound. It's not really, in my mind, a mansion. Like, I think a mansion, like 15, 20,000 square feet. I think like, massive, massive compound. So it's not that, but it's definitely a step up from a McMansion. Some people have used the term McMansion, and they're buying these 4,000 square feet houses, and they're calling them mansions. This is a step up from that for sure, but it's not a proper mansion. It is very well utilized space. All the space within the entire house and guest house, etc., all of it is going to be used and or utilized by being rented out and turned into cash flow. That's just how I roll. I'm going to use all of it and I have a big family. I have in-laws that are over all the time on both sides. I entertain often, so we will get a lot of value out of this, and all the space will be well utilized. Yeah, so anyway, didn't think I could outgrow my current house hack, but I actually think with the third kid and the dog and the in-laws and everything that's been going on lately, it's actually possible for me to outgrow my current house, and that's what we've done. We've outgrown our current house, which I didn't think would happen, but I also didn't expect to have a third child and a dog. But here we are, right? Or having in-laws live with me and things like that, or my own parents live with me, right? Those are things that we didn't initially consider that are now on the table. And so super excited about being able to provide those opportunities to those people in my network. And that to me is the ultimate house hack, and the ultimate goal of Lux Fire is to be able to support those people and have the mechanisms to support your family and your immediate family and all those people who are close to you and your friends. It's about being able to give back too, and I can do that with this compound. It even has a really cool games poker room and a lower office, which I could bring people in, maybe even do some sort of training programs or something like that. Might be something fun to do. It might even just be for charity. Like, I don't really have an intention to monetize it, but I'll think on it. Maybe there's something we could do with that too. So there's lots of cool things, lots of cool opportunities with this this compound that sort of fell in our lap, and I've been mulling it over for a few months now, and it just kind of everything came together. So here we are. We're working towards it, and we'll be enjoying the summer at our old house and getting it ready for sale. And hopefully we can get a good price on our current house to help offset the move to the new place. But either way, it'll be all right. Lux Fire, 100%. Rage Nerd says, oh my God, is that the start of the fire compound you were dreaming about? I mean, it could be. It totally has the potential to do that. And I think it will be definitely a house hack. And the people that are on the compound living with us or living in adjacent units would be having to have the same fire mindset for sure. That's something that I value. Even in the house hacks that I've done up until now for the last almost 9 years I've been house hacking, all those people I've lived with have had major impacts on my mindset and on my my personal life. And so having the right people around you is so important. And I think people undervalue or underrate having people around you. I think a lot of people just live in their own house. They don't want to have any family live with them. They don't want to have any roommates. They don't want to have any other units that they rent out. And I get that. I respect that. At the same time, it's not just about the money. You're leaving a lot of opportunity to learn and to engage and to grow by not having those people in your life. And so I've been pushed by having mentees live with me. I've been pushing myself, and I've been called to action in many ways that I wouldn't have before. And even personally, I enjoy at the end of the night when my whole family's gone to sleep. They're all early risers, and I'm a night hawk. And so it's nice to be able to have someone else to hang out with even at the end of the night. And so there's value in, I actually, in some situations, might be willing to pay to have someone in another unit that I enjoy their company, right? I've even thought of that at certain points, that it's actually a value add to have another unit that you rent out, or even have other space the idea is you want some separation at times, right? Like, you might not want to have them engaging when you're having a family get together or something, right? But it's nice to have that, I think, in a lot of ways. And so I'm I think it's super underrated. Next one is congrats, thank you, congrats on the birth of your daughter, thank you, congrats, thank you so much, appreciate that from everyone who's in the comments right now, really appreciate it. And if you're watching the replay, I appreciate your comment. Hit the like button and drop a comment, let me know what's up. I'd like to connect. I'm happy to read all of the comments on all of the videos on the playback. Ishan says, I saw the new video by Meet Kevin, and he has legitimate insights on the market not crashing compared to the issues we faced in 2008. What are your thoughts on the market going to be good in 2021? So I haven't seen, Kevin releases and I love Kevin, by the way. I even watch a lot of his morning announcement stuff. I let it play in the background when I'm doing my options trading in the morning, but I don't have time to watch all of the content that Kevin produces, and I don't know the video you're talking about, so I can't comment on that video per se. I do think that it's too early for the Fed to lean in and raise interest rates. And so depressed interest rates at all-time lows continues in combination with the stimulus packages that are being released by Canada, the United States, and many other developed nations. All that money printing and all that cheap money, so money's just free flowing and it's cheap. The intention of doing that is to ensure that capital continues to move, that the wheels of the cog of the economy continue to move smoothly with lubrication. I think that an after effect of that, and even admitted by Powell, is that there is going to be some inflation. There is going to be a little bit of devaluation of the currency until the economy, at least in a best case scenario, until the economy catches up to the money supply, right? When M2 is skyrocketing, you're printing money. The hope is that it stimulates the economy, which it's doing, and that GDP grows to catch up with the money supply. And so the hope is that the value of the dollar does not drop. Short term, the value of the Canadian dollar and the US dollar and other dollars all pegged to the US standard, they are all going to go through a bit of inflation. So we will see assets like land and real estate and a lot of the stock market right now continue to pump as a direct result of that. Irregardless of how companies are performing, that cheap money gets investors wearing the rosy glasses. And when investors wear the rosy glasses, we see overvaluations. We will see multiples on earnings to be much higher than I think maybe they should be. And so that will continue to drive prices up. So I am bullish on 2021 real estate and bullish on pretty much any hard asset, including specifically those commodity assets used in any of the tech space. So anything used for batteries or the development of EV cars, I think that's the trend, or anything related to AI or the Internet of Things, or any of the latest and greatest tech. Going to graphics cards as an example, because I think cryptocurrencies are the thing of 2021. We've seen this insane bull market in the crypto fugazi, right? I think, and it is really fugazi, but there is a huge value in the fact that everyone believes, or at least many institutions are now backing, and many different people have now gone onto the network, believe in various cryptocurrencies, including Bitcoin being the leader and the sort of signal, and all the altcoins sort of following behind that. I think that Ethereum potentially has some potential, not to the same degree that I think Bitcoin does long term. And if you're looking for like high speculation, high return, but a bit of risk, there's some really cool altcoins you could explore. Again, it's fugazi, and so if anything happens where a new, better tech does what that altcoin was meant to do better, that altcoin's worth nothing, right? So you have to remember that tech is ever changing and ever evolving, and the real value in like Bitcoin is that it has institutional wealth behind it, and it has a huge network of users, and all that computing power and all that widespread adoption gives it value. So even if the technology is worse, because it has the widespread adoption, it is the market leader, it does have some inherent value. So I value, and by the way, I'm not putting a huge percentage of my net worth in cryptocurrency. You guys know I keep like 1% to 2% of my net worth in crypto, in fact, even less than that. And I like to do it, in fact, I would prefer to do it through investing in the hardware, like buying graphics cards and building rigs, and then mining. In 6 to 8 months, I get all my money back on that equipment. I can, even if it's depreciated, I've never lost money. So I buy the hardware that I know has multiple use cases, including gaming, where if cryptocurrency falls, I can sell the hardware and recoup my money. And then I mine back my investment. And so it's 100% return typically to do mining right now. It can be 200% return depending on what you can pick up from a graphics card perspective. If you can buy at MSRP, which is impossible right now. You got to buy it from scalpers. But I think that's a great way to get invested in crypto. And if you want to mine some of the altcoins, to have that, to the moon mindset, and you're like, hey, maybe you set 10 grand aside and you get a little rig and you set it up in your house and you mine some coins. If you bought a rig for like 8 grand, or you built a rig for like 8 grand or less, you should be able to mine 10 grand a year at current prices of a lot of the like Ethereum, or even some of the altcoins pay even better. So there's definitely a huge amount of potential, I think, in that space. But I'm going on a tangent. You were talking about overall 2021, to circle back to the question, you're talking about overall 2021 performance. I think that in general, most of the asset classes that will float with inflation will be having a positive outlook. Does that mean that the real economy will produce above inflation? And I mean real inflation, because the government might call it 2% inflation, but they've been calling 2% inflation in Canada for 3 years now, and the average Canadian spends 50% of their budget or more on housing, and housing has been up 15% a year, including rent, which was up 20% a year over the last 3 years. In fact, a one-bedroom apartment 5 years ago in my city rented for $650, and today rents for $1,300, $1,400 downtown. So we're talking a double in rents over a 5-year period. Anyone on fixed income, they're really feeling it right now. So I think that, and by the way, people who are advocates of like CPI, the CPI guys are great, and the people at StatsCan are awesome. I think they're manipulating the numbers just a tad, because I don't think inflation is anywhere near 2%. Go to the grocery store and see for yourself 5 years ago from today. Go on the MLS and look at housing prices in any of the developed nations right now. And house prices are all up everywhere, for the most part, in every desirable place where there's also rampant stimulus and money printing as a result of that. So yeah, I mean, that is something that I think for 2021, one, I guess, catalyst for a pullback on some of the things that are more speculative or growth focused. Specifically, I'm talking about tech stocks, could be rising bond yields. Investors are craving higher returns, and as they crave higher returns, and as they expect a little bit higher yields on the bond, they will then therefore value the tech stuff a little bit less, right? There'll be a little bit lower valuation there. But again, they're printing so much money right now that there's a lot of DIY investors that are just going out there and buying like GameStop or Tesla because they like the company. They don't know anything else, but they just like the company. They want to invest in something. And so that whole era of investing is different than it was 10 years ago with institutional money. Now people driving the economy are people who got a D in high school and dropped out and have $1,000 stimulus, and they're just gonna go buy some Tesla stock. And it's 1,000 of those people on Reddit that all go and buy, right? Who know nothing, unsophisticated, and they can drive markets. And so, I might think that GameStop's worth $10 a share. And I'm just throwing a number out there. I've never done a valuation on GameStop, but if the market thinks it's worth 300 or 400, it could trade at 1,000 times earnings. If that's what people believe, that's what it's worth. Despite intrinsic value, market value will be whatever people believe it is. But yeah, I mean, the old adage with institutional investor mindset has changed now with all the DIY investors in the market. And so I don't know. More now than ever, I don't know. I know that they're printing money and there's a free flow of money and everyone has more money than they should right now. And so that should result in assets like real estate and all the hard assets appreciating at a rate of at least the real inflation correlated to money supply. So I think that I am bullish. I will say that I'm bullish. I am levered right now in my stock portfolio to the point where a pullback would hurt. So I'm betting there's not going to be a pullback. I could be wrong. I should probably go buy some deep out of the money or deep in the money puts and just protect myself for those worst case scenarios. Do as I say, not as I do. Don't lever up. There will obviously be corrections. That's just the nature. Buy a solid diversified portfolio and hodl. That's the mindset that I believe we should all have when we go into investing. Buy things you want to hold for long term that pay solid cash flow. If you're investing in growth stuff, it doesn't pay cash flow. It doesn't pay any dividends. Doesn't have any really good earnings, like Tesla or all the growth type stocks. That's cool. That can be a percentage of your portfolio. But make sure that you're in it for the long term. I think that's the best way to be investing, is having that long term horizon perspective. Like, I do think that long term Tesla has so much potential. Do I think it's going to pay me anything today? No. Do I know what the price is going to be of Tesla tomorrow? Could be 590 in the next couple of days. Who knows? We've seen it jump from highs of almost 700 down to what was in the trading in the 630s today, right? Anything can happen. GameStop could be half of what it's trading at right now by Friday. Who knows? So I don't have a crystal ball, but I do believe long term that there are many factors pushing hard assets higher in price. And so cryptocurrencies, gold, silver, land, stores of value are fantastic. As opposed to gold, I prefer, 40% of gold's price is utility, so used in manufacturing and whatnot, and 60% is a store of wealth. And I think over time, people are shifting from gold as a store of wealth to other hard assets. Like there are many other hard assets like silver, the poor man's gold, or even like copper or steel. You can pick any other. Copper's a great one, by the way, especially in tech. They use a lot of copper. I think that long term, that's a really valuable metal, and most people aren't using copper to store wealth, but it's also a good store of wealth and would rise with inflation. Look at the price of lumber right now, right? And a lot of that's due to supply and demand curve issues related to COVID delays, but we also have to think about some of the inflationary pieces that are at play here with related to the amount of money they're printing. So that's my sort of high level thought, and I'm by no means an expert. I have my ear to the grindstone, and so that means I don't hear everything. I just hear what I'm listening for. So one perspective. Big ups on baby number 3. Thank you. Congrats. Thank you. I want to connect with more like-minded Canadians in the sense of FIRE investing and basically people who don't want a traditional job. Outside of LinkedIn, any suggestions? So LinkedIn's an okay way, I guess, to connect professionally. I've not used LinkedIn to connect on a personal level with people. I think a better place is Facebook, and go join all of the, Choose FI, London on Fire is our group here in London. Feel free to join our group on Facebook. I also have a few groups that have like 1,000 people in them as well. Like Fired Up Finance is one of my groups that has like 1,400 people. Join that Facebook group. It's got a lot of people in there that are like-minded that share. You can at least go on that list and start friending people. There are tons of Mr. My Mustache, Mad Fientist, a whole bunch of different fire type, Lux Fire, regular fire, lean fire groups on Facebook, tons of groups on there. You could post and say, hey, anyone in the London area love fire and want to meet up? And I'm sure they're probably going to point you to somewhere where there's a meetup already happening in your city. And if there isn't, I'm sure that in one of those groups with 40 or 50,000 people, that there's someone in your city that's also loving this stuff. So that's where I learned about fire. Before all this stuff was sort of more widespread, I just went on and looked on blogs and then went into the blog forums and the comments and just tried to find people from my city. And that's sort of how we founded in 2016. I think it was 2016, fall of 2016, we founded London on Fire, and it's a meetup that was once a month. Before COVID, we don't meet much anymore because COVID sort of shut all that down, but we used to do a monthly meetup. And that was something that I really valued. Until, the last couple of meetups, I'll be honest, I really didn't get a lot out of them. I felt like it was like an hour and a half of people just grilling me, asking very basic questions. So there is value to that though. Like, again, I do like to go out once in a while to those, but it is really nice to connect with like-minded people. And I find that when I go to those meetups now, I get fans that reach out. I love that, by the way. That's the best. The first 5 minutes of that conversation is fantastic. And sometimes we just kick it off, but sometimes I'm stuck in a conversation getting asked the same basic questions again and again. And that part sucks a little bit when you're connecting with people. You want to find some way to jive and get value out of the conversation for both parties. So something to think about for myself going forward. I've been having a lot less value from those meetups, but I do still find there's some value in giving back, right? And yeah. Next, Benefitness Studio says, what ended up happening to your development near the water? Good question. So we sold off the entire thing. I sold the lots off about a year ago, and the house, and it's a shame because it all doubled in value. And I really am kicking myself today for that choice. Probably left $1 million on the table. But at the time, we were bleeding. We had private financing on it. We were dealing with issues with the city and delays. It took us, over a year to even get to the point where we had the full severance and everything in the development agreement signed and able to bring in the services for utilities. Had I seen that all the way through, I would have made much more money. But in the end, we did do okay. We made some money. I can't complain. It was, well over 6-figure return. Could I have done better in the rental market? Probably. Yeah. I think that trying my hand at development, there were a lot of red tape pieces that I didn't see going into it, and the time it takes to develop is what really kills you, especially if you have private financing associated with that. So if you don't have deep pockets, and there's a lot of unknowns along the way too, right? They can just say no, and then it's like, okay, great. Like I tried for the severance, they said no, or I tried to build this, they say no. And it's like, great. So you want to have those conversations before. I didn't know when I had a commitment from the city on something, and that employee changed out of the municipality, and it was a whole different set of agreements when that employee changed over. And so I went through that with development and realized that I wasn't a big fish. I didn't have any way to lean in. And the new employee or engineer that sort of leaned in from the city had different ideas. And it cost us like 100 grand difference on some drainage issues. So yeah, I mean, I'm still responsible on the hook actually after having sold those lots to go back and fix that issue. And so that's something that we're dealing with right now still. So despite them being sold, I'm still dealing with some of the aftermath of that, given the fact that I signed the development we signed the development services agreement on those severed lots. So I don't own them, I don't get any of the benefit, but I'm required to make sure everything is to code on bringing those utilities and the drainage, etc., to those lots. So I didn't have fun with development. It wasn't for me. It still had a good payoff, and I get it. Like you know, we bought it for 400 something, sold it for over, or what did we buy it for? Yeah, 400 something, sold it for over $1 million. Sounds great when you hear that, but you don't factor in all the costs, all the holding costs, all the time investment, all the stress, all the risk. Yeah, we made money, but at the outside, it sounds good. But when you peel back the onion, you look at the different layers, you're like, oh, this wasn't actually that profitable, given the return on time and how long it took to get that return. So, and given other opportunities that I had available to me. So, yeah. Best way to grow a TFSA. In my opinion, the absolute safest is the best. And in fact, this is what I'll say. I think that if you were to do lending and lent personally some cash from an unregistered account, say you put $100,000 from an unregistered account in a first mortgage, and then you lent out from your tax-free savings account a second mortgage or a second mortgage on the same property. They're effectively, you control the title of the first and the second mortgage, so it gives you a lot of power, but your tax-free savings account you're gonna pay that 29% return, and maybe you'll pay your other, first mortgage a lesser amount. And that way your second mortgage on your TFSA is growing your tax-free savings account at a 29% CAGR. CAGR stands for compounded annual growth rate. And anything growing at 29% doubles every 2.5 years. So in 10 years, you'd have 5 times. You gotta remember, you start with 70,000, becomes 140, then 280, right? Then whatever, almost 600, and then again, 1.2 million, and then 2.4. It's very quick to grow the TFSA over a 20-year period to well in the 7 figures if you use this method, rather than investing in growth stocks where, another thing to mention too is interest income is fully taxable outside of the TFSA, and inside the TFSA it's fully tax-free, whereas capital gains are already half tax-free. And so I think that the capital gains are meant to happen outside the tax-free savings account. So don't do the speculating inside the TFSA. It's tax preferred to speculate and do capital gains outside of the TFSA. I think it's better to do interest-bearing stuff that pays really high yield if you can try to manage that risk and lend to people that you trust, who maybe just are in a pinch doing a flip or something, and you're secured against title. A decent loan to value with a fantastic interest rate, you can't go wrong. That's what I'm personally going to be doing. Once I have enough of my TFSA that it makes sense, I have someone in mind, let's get to a 6-figure amount, about 100,000 in my TFSAs, myself and my wife's TFSAs, we will go over to somewhere like Olympia Trust or one of the other various trust companies that you have to use to lend from your registered retirement accounts or your TFSA. And so I'll use them. There's some fees associated with that, but 100% I'll definitely be using the TFSA lending growth strategy, and it's very powerful. With the RSP, it is also very, very powerful, and I think it's underrated and is totally legal under 29%, is my understanding. That's the maximum return you can pay that is considered fair for the risk. The government won't lean in and say, hey, you're making too much in your TFSA, we're going to take away this tax-free ability and tax you on it. That happens, by the way, to active traders who actively trade in their TFSA. If you're trading stock, they might consider you professional, and if you're professional, then they'll garnish some of that tax-free savings in your TFSA. So just be careful if you become a professional trader in your TFSA. It's better just to hold long-term debt instruments, actually, is the ideal from a tax maximization perspective. Dihatu says, congratulations on the birth of your daughter. God bless. Thank you. Next one. A lot of businesses are moving to the city to live in, and I have a few properties. I have never raised rent on any of my tenants. I see that I am charging less than a 1-bedroom apartment. All my tenants let's see. And the second part of the question is, live in a 3-bedroom, 2.5-bath house. Do you think I should start raising the rent? There are good renters who pay me on time. This is one of the challenges with not raising rent over the long term, is that you end up in a situation where the real inflation rate is like 10%. And like, especially in housing, it is at least 10% over the last 10 years, for sure. From a rent perspective, I think house appreciation prices are even higher than that, especially in the last 5 years. We're seeing last year 28% growth on the average house here in London, which is insane. If you don't raise rents, then you end up in a situation where they're way under market. And you got to remember, your hydro rates are going up, your property taxes are going up, the value of your house is going up. And so therefore, the cost of capital is higher for you each and every year that it appreciates in value. And so you've got to factor in that you might have an asset worth $1 million now that's bringing in the rent of a $200,000 building because it's appreciated a ton in value. And so now it makes sense to pretty much just sell the property, but then no investors want to buy it because you're renting it so low they can't make any cash flow at current market prices. And so it's a real issue where if you don't raise rents, you end up in a situation. And even if you raise rents to the inflation guideline, good luck, because it's not going to keep up with prices or market rents. So it's just, ideally you want some turnover. My ideal tenant stays for 2 to 3 years, 4 years max. That's why I like students. That's why I like people who are transitional, who've moved to the city, who want to buy a house and have great, financial track record. And they're like, hey, in 2 years I'm going to buy a house. 3 years I'm going to buy a house. I'll sign a 2-year lease. I might stay 3 years. I'm like, that's my ideal tenant. So when I pick a tenant profile, I'm looking for someone who wants to move on, like a student who's going to be here for 3-4 years, a master's student, or someone who wants to have kids and buy their own house and who has a good, financial situation. That's an ideal tenant, I think, because then you don't have to worry about raising rents. For the 3 years they're there, you're good. They're going to leave and you can get market rents again. So you can actually pick a tenant profile that doesn't want to stay forever. And you can just straight up ask, like, hey, what are your plans long term? Do you want to buy a house? And you can get a feel for the type of person that they are. And if they can actually qualify, do they have a good credit score? Do they have any savings? And if they do, then they're probably a good candidate to buy a house. Whereas if they have bad credit score and no savings, like they're probably not buying a house. Even if they say they're going to buy a house, you have to look at this with a proper lens to view the world, right? But what do you do now? I guess even if you raised your rents by inflation, you'd never even catch up. Like the guideline with COVID, rents were frozen, so you can't even increase rents during COVID. So we're stuck. But even if you could increase rents by the 2% or whatever, you never catch up. Like rents will keep rising faster than you're going to be able to increase it, the 1.9% guideline maximum. The only way is to have a conversation with the tenant and work to something. And I think the best way is when you can come to an agreement. And maybe they've been there a long, long time and their unit's dated. You can come to them and say, hey, I want to increase the value of my property. I'm going to go refinance it. Or maybe not even come in with that aspect. Say, hey, I want to put a new kitchen in here. I want to make this place modern and awesome. Could we come to an agreement on a new rent price if I did all of these upgrades for you? Maybe you didn't have laundry before, put it in. Maybe you didn't have dishwasher before, put it in. And you have a conversation about that, and maybe they'll be willing to come up in rent for you to do the improvements. I had a couple tenants actually approach me about that, and we came to a new rent price. And as long as everyone's in agreement and they continue to pay it after, I think it's 6 months or a year of them paying that, their new rent is set, and that is their rent, regardless of whether there's a lease in place or not. So you can raise rents above the guidelines. There are ways to do that. That's one way that you could do something there. But yeah. For a new investor, would you recommend they go to the stock market, real estate route, or real estate over stock market route? So yeah, I mean, it really depends. It's hard for me to say there's one better than the other. I love real estate. Like, I built my wealth in real estate. I think that with real estate, you can develop a competitive edge or competitive advantage in a way that you can't in the stock market. It's very hard to develop a competitive edge in the stock market. There are so many smart institutional investors out there that will just destroy you. The amount of time it's put in to be a competitive edge stock investor is like 12 hours of reading reports. Like you had to be like Warren Buffett and reading reports 12 hours a day. If you're going to spend 12 hours a day digging deep into companies, doing financial analysis, looking at balance sheets and income statements and everything, and really having a deep understanding of the companies you're investing in, and continuing to watch the market news on those companies and all the different analyst coverings, you got to be reading all the analyst reports. Every single analyst that's covering that stock, even the bearish ones, including the bullish ones, you got to be reading all those reports. If you're doing all that work, you're putting all that time in, then yeah, I think the stock route is a fantastic way to go. You won't grow as fast as you would in real estate, because in real estate, you can put your time into arbitraging some insane value using leverage. And you can do that in the stock market. You can use interactive brokers. Use my referral link. I'll post it again for everyone in the comments. Go back to the last couple of my videos. I'm posting a link. If you join, you get free shares in interactive brokers. I get some free shares or some free referral money. So if you're gonna join interactive brokers, even if you're doing a paper trading account, which is just practicing trading, it's no real money at stake. You can just pretend to trade and learn. Even if you're doing that, check it out, interactive brokers. They're fantastic if you want to actively trade. The real reason to use interactive brokers, though, is that companies like Questrade charge 7% interest rate on the margin that they lend you. The money they lend you to buy stock, or the money they lend you to, you can pull money out too. So you can put $1 million in interactive brokers, buy some shares, and then pull out $700,000 on a line of credit at 1% interest. So prime minus 1.5%. Most people didn't know that. Interactive brokers offers the cheapest lines of credits and the cheapest interest, automatic approval. Like, you have no income, approved. Put the money in the account, automatically approved. They'll lend you the money back. If you don't protect your portfolio and leave a little margin room, they will margin call you and sell shares in the event of a downturn. So protect your downside. Don't borrow the whole line of credit. You know, obviously have those conversations with your accountant and whatever, and your investment advisors. It offers a unique situation where if you use, 5% down to buy a really good property under market value, you're super levered. A 5% down deal is levered 20 to 1. So if you're buying a $100,000 property, you have 20 times the buying power in your money. You can't do that in the stock market. But at my stage in the game, where banks are telling me, hey, you have so many properties, Mike, you got to put 30% down to get a good rate, technically. But you'd really have to have a lot of available cash for a margin call. You'd really have to be buying some puts on the positions in your portfolio to ensure that if there's any down, respond to a contractor or whatever. So, or look at today I was options trading, reading market reports or whatever, laying with one of the kids or two of the kids at the same time. That's just the life. That's just the life that I've chose as a dad, and it's the fire lifestyle for me. This is my game. This is my jam. So it's tough now, but it's going to be really, really rewarding later, and all the rewards far lifestyle. But teach their own. Next question. How are you and the family doing? We're doing well. We're recovering, Gail. Again, I've talked about it on the channel a bit. We're tired, but we're making it through. David says, do you recommend borrowing on a HELOC for investing in a TFSA or in a non-sheltered account? Aren't the tax breaks offset by capital gains in a non-sheltered account? So if you perform the Smith maneuver, which is the idea that you can take money from you borrow, put a line of credit on your house, and you borrow money in your house, and then you make that interest that you just borrowed to invest in something completely tax-free. That's called the Smith maneuver. You take the money from your house and go invest it in an asset. If you go move that into a tax-free savings account, I don't believe you get the deduction because there is no tax on what you invested in your tax-free savings account. It's completely tax-free. So if you're gonna borrow money from your house, borrow money and put it directly traceable into an open account that is fully taxable in an ideal world. It could make sense to borrow from your HELOC to put in your RSP because then you get a tax deduction against your active income for that year on the RSP contribution. So that could make sense. If your earnings are at a high enough level that they're higher than what they'll be in retirement, then it would make sense if your marginal tax rates are at that level, David. Watt says, hey Mike, do you have a PREC for your real estate business? I recently got my license and I've already made $300K in commissions. Thoughts? Geez, you made $300K? You just became a realtor? What? That's amazing. I make like nothing as an agent. I do a few deals a year. So I don't understand what it's like to make that kind of money. You gotta really be hustling. You do a lot of deals. That's awesome, Watts. I don't know what PREC is, but maybe you can enlighten me what that term means. I have a corp, if that's what you're trying to refer. I don't know what PREC means. I've had an assistant at times. Right now I don't because I'm not doing a lot of volume, but I have had an assistant. It made a lot of sense when they were writing offers for me and they were helping me fill the paperwork. So just at your level, 100% you need an assistant. For sure, you might even need a junior agent under you, probably at 300,000 commission, and you definitely 100% need a corp for that. It's now legal in Ontario to have a corp for your real estate income, so you should definitely do that. And by the way, congrats on that. That's awesome. Russell says, do you think that many first-time investors who are burned by the whole GME thing will disenfranchise from investing again in the future? I don't know. I think that the Band-Aid's ripped off and people have Robinhood accounts, and I think that people just move from one investment to the next. And in my mind, once you've ripped off the Band-Aid, it's like gambling, but with better probabilities. And so I do think that I think that people might get burned, but they'll want to get back in, right? Because the feeling of the high when you make money stock trading is, like gambling. And again, you're investing in companies, you're not gambling. And so no matter what, even if you're buying GameStop, I think that GameStop's a better use of your money than going to the casino and putting it all on red. I think that at least you're investing in something. Maybe GameStop's worth a quarter of the current stock price, but at least you're getting, at least you're buying some real value. At the casino, you're literally just, if you play enough, you just lose to the house. So yeah, I mean, it's a better form of gambling than straight up gambling, I think. So yeah, I mean, I don't know. I really don't know. I think that most people will continue to, even if they get burned a little bit, will continue to invest in something else. Human psychology is such that they'll blame it on something else more likely than not. If we saw a whole bunch of people get burned on GameStop, probably there'd be some lawsuit or something that would help them get some money back, or they would just blame short traders or blame institutional investors or blame something else, and they won't take accountability. It's not like, hey, it's my fault. I invested in a company I did no research on. I didn't know anything about. What was I doing? I was an idiot. Instead, most people will not do that. They would get cognitive dissonance if they did that. Most people instead would just, they would say it's someone else's fault that this happened, and then they would try again with something they found on Reddit to invest in, probably, is my guess. Next one is, I'm thinking about 6-month SPY calls in the money. The risk with calls is the premium you pay for the right to be right in the future is really expensive, especially on something like SPY, probably. And I haven't looked at the premium, so I don't know. Maybe there's a certain strike price where there is actually some inherent arbitrage value. I don't know. But my feeling with buying calls is I try to avoid them unless they're covered. That's just my thought. Unless I see something that's extremely undervalued and I have a catalyst. And a catalyst means that a catalyst is an event that will trigger the outcome that you'd like. So catalyst would be like, think of an example, like we were talking about GameStop a second ago. So GameStop, a catalyst for it rising is like GameStop, finds a way to be the leader online. Maybe they roll like some NFT token to like resell games or something, and that like revolutionizes the industry, and everyone's only buying games there because they can resell them within the GameStop platform or something like that. I just made that up, but that would be a catalyst, and let's say that drove revenue or could drive revenue 100% or whatever. That would be a catalyst for growth on the stock. So unless I knew I knew there was a catalyst that was certain to happen, and there was good intrinsic long-term value, I probably wouldn't be buying calls unless there's really cheap premiums. So it depends on the premium cost, I guess. So if you're way out and the premiums aren't too bad, and you're like, hey, there's a pretty good chance the SPY is going to go up, make some money. When you buy calls instead of buying the share, and if you're actually just going to buy the shares or instead of owning units in SPY, you might be better off just to buy some long calls. Yeah, I can see that. I can see that. I'm just so conservative that I'm not buying a lot of calls, but yeah, I can see that. It's something you're super bullish on, you're sure about. Okay, next question. We're buying a home to house hack. How do we shop for the best mortgage without having tons of hard checks on our credit? Well, the best place to go, Jamie, is ratespy.com. I have no referral. I have no benefit at all by saying that, but they are the best. There's Rate Hub, but RateSpy is better. Go to RateSpy. They will tell you, there's people who go to SPY at all the lenders, and they will tell you the rates at every single lender, the best rates you can get at every single lender. Some lenders pay to be on there, and especially the ones that have low rates will pay to get on that website. And you can just click and buy the best 2 or 3 and then get approved at the best 2, let's say, and play them against each other. And maybe they can sharpen their pencils a little bit, and that'll get you the best rate in the market. I use that to get a 1.34 5-year variable on my personal house. Fantastic website, great place to go, and you can then shop all your rates before you go and apply. Is there a rule that exempts same credit check within a certain period? No, unfortunately not. I've had Scotia do like 6 hits in 1 month for me. It's brutal. Destroyed my credit temporarily before it rebounded again back into the 800s, I think it is. On my peak, I was like 880 credit score, which is almost perfect. And at my low, just from applying for a lot of credit, I was down to like 600. And again, I pay my bills. It's just that I had applied for so much credit. At one point, I think I did like 10 mortgages in 1 year, applied to 4 different places. That was 40 credit checks. Applied for 4 lines of credits at like 4 different places. That was 16 more credit checks. I set up 7 internets, and I shopped at Bell and Rogers and switched, I think, on like 6 of the rental properties. So I had like I had like 70 credit hits in like such a short amount of time. My credit score was like a list of how many times they'd hit how many hard inquiries and soft inquiries I'd had on my credit, that it just like decimated things. And then I had drawn down lines of credits to do deals, and so my utilization was bad. And so I've floated around the credit score, and it sucks. It's just the game. You gotta say, like, people who have great credit scores that go down short term typically rebound because they pay all their debts. But if you have a really great 880 credit score, I'll almost always say it's because you're underutilizing the debt that's available to you. And debt is like free right now. There's so much cheap money out there. If you can go borrow at 1 or 2 or 3% or 4% or less, you should go do that, because anything you can invest in will probably give you a better return. And if you're investing in stuff that doesn't provide better return than that, you should reevaluate your investor, prospectus, and look for better overall investments, in my opinion. And I've had it out with people in the financial communities. I tend to get on there and get in the comments and argue with people in the FIRE communities and on the Choose FI posts and stuff. And I've argued with people who like to pay off their house and pay off their mortgage, and I'm like, you're guaranteeing yourself like a 2% return on your capital. That's terrible, in my opinion. I would always have a HELOC available, and I pretty much always have it drawn down, or at least have it there ready for when the market dips, so I can buy the dips hard. Like during COVID, if you had a HELOC in your house, if you draw that all down, you should have bought everything. You would have doubled your money in 6 months. That's just buy anything. Buy the S&P 500 during COVID, right? When those dips happen, you got to buy the dips. And having access to cheap money to do that will accelerate your journey to FIRE and accelerate your journey to building wealth long term. So debt is a weapon that needs to be wielded properly. It is the best tool in your toolbox to build wealth. Every single investor that I know is able to use debt and has used debt to build the wealth they have today. They're buying businesses and they're using debt to finance that. They're buying properties using debt to finance that. They're buying everything. And so debt is a great thing. You should definitely borrow as much as you can, especially in times where they're printing so much money. Debt is devaluing. So why wouldn't you take the bank's money and go put it into hard assets and let it ride? That's my thought. Obviously diversify, obviously protect against your downside. Have a small pieces of a lot of things. Don't put it all in GameStop. Buy 100 different companies and split it all into small amounts so you can't lose it all. Be conservative, but also be willing to take some risk, because a little bit of risk managed will give you great returns with leverage. There you go. Hey, how you doing, Yishi? I live in Toronto where homes are over $1 million. Yeah, that makes sense. If your commission's like, here in London, it's 1% for selling and 2% on the buyer side is very common, so 3% total. It's weird. Toronto has higher house prices, like double, and their commission is like 2.5 and 2.5. I don't know why the agents they've like come together and agreed that like you get a high commission. I don't know why. In London, it's like a race to the bottom. It's like PC 275, like guy has Rosehart 2.59. There's like the 0.59 realty. All these like listing for like 0.5%. There's just so much of that race to the bottom here in London. I don't know why. We just have a lot of agents here, I guess. But definitely something that's awesome, in my opinion, that you're able to sell so many homes and get such great commission. Next question is, any advice for finding a good financial investor, or is it better to do it myself? A mix. I have a financial advisor in private banking with Scotia and with BMO, and I'm happy with both of them. I went there, though, not because I needed a financial advisor, but because it was part of the private banking package that I signed up for, with the intent that I would buy businesses in the future, and with the intent that I could get really good leverage, line of credit on that stock portfolio with them, and with the intent that if I wanted to buy properties or whatever, the lending pieces and the connections to the businesses that they were managing stock portfolios for added enough value that it was worth the fee for me. So that's why I have a private stock portfolio that I have an advisor that's managing. So they have a team, they're analyzing all the stocks in the position. Their goal is to generate cash flow through dividends for me in a tax preferred manner. It is nice having a team. At the same time, I can see that the fees that I'm paying are, I don't know what I pay, less than a percentage point, but still that adds up, right? And pros and cons. It depends if you like reading about stocks and learning about stocks and and just watching your portfolio a bit, then I think it's probably worth it to pay yourself that fee and add that every year to your portfolio. But again, it just depends on your personal situation. I think you could learn it all yourself and invest yourself and save all those fees. We're all pretty capable of that. But if you can get other value or other benefits from having the advisor, could be worth it. For the investing itself, I don't think it's worth it. Like if I didn't have the lending pieces attached to the private banking stock portfolio, I don't think I'd be doing it. I think I just manage it myself. So yeah, I do have my own portfolio that I manage myself as well, because they don't do options trading on the private banking side. and I wanted to have more tools in the toolbox. But yeah, I mean, teach their own. Thank you so much. Hey, no problem. Happy to help. Mike, I have a property worth $1.5 million, DD says, but I get only $72K a year in rent. It's renovated, so good for 20 years. Do I sell it and look for something better, or keep the $72,000 as a base to loan and buy more? The first issue is you have a $1.5 million property with no mortgage on it. That's an issue. $1.5 million, you could give me $1.5 million. I'll make you a proposition right now. Sell that property, or better yet, go get a mortgage on that property for 80% loan to value. Take the, what is it? You said it was $1.5 million. So you'd be at 80% loan to value, you get a $1.2 million mortgage. Take that $1.2 million. If you lend it to me right now, I'll pay you $10,000 a month. And I'll secure it against all my properties, which have lots of equity in them. So you'd be under 80% loan to value. If the market pulled back 10 or 15% on real estate prices, you'd still be above water. Your loan would be completely safe and secured. I'll put that offer out there right now. Yes, there are better, and that's for anyone watching this right now. If you want to lend me money, 10% return, guaranteed, secured against my properties, I'll pay the legals to secure it against properties that I already own that have good loan to value available. Yes, I think that $72,000 a year in rent, that's not your net. You got property taxes, you got whatever, insurance, CapEx, a roof goes, furnace goes, whatever. You got maintenance, you got risk, whatever. No, it makes no sense. Your return is like 4%. I think that it doesn't make a lot of sense to own that property, but there could be tax complications with selling it. And so I could understand an argument for keeping it return than the property itself, right? You're talking like a 3 or 4% return on that property you own in cash, $250,000 in tax on that. So still probably worth it to sell. But let's say you're hard pressed on not paying that tax and you ran the numbers refining it. Reason being, there's no demo associated with putting a metal roof on top of an old shingled roof. With shingles will go bad. They'll put another layer of shingles on. In those situations, the demo cost to remove all the shingles and put new shingles on is actually more expensive than a metal roof, and a metal roof lasts forever. So there's situations where the metal roof is 100%. And any flat roofs that I have in my properties, I build a pitch and I put a metal roof on. That's just my preference. It's how I like to go. But I do shingled roofs where it makes sense. So it just depends on the situation on the property and so many factors. But metal roof is better long term. Shingled roof is just fine. A good shingled roof can last 25 years in most climates. So depends on your time horizon you want to hold the property for. Resale wise, it shouldn't make a big difference. What's realtor commissions in the GTA? The GTA, it's typically about 2.5% on the buyer's side, whereas in London it's around 2%, sometimes 1.5%. Very typically 2% here. And then on the listing side, it's whatever you negotiate, but typically it's another 2%. Here in London, it's often 1%. Would you invest in London and Windsor now? I am investing in London still, but only where I can find opportunities. Less so now than I was before, but there are other factors playing into that too, I think, beyond just market prices. It's also just time. I'll have to replay that. Hey, no problem, Dee Dee. Happy to help. If you want to reach out to me, my email is on there, rosehartcoaching@gmail.com, or you can find me on Instagram at Mike Rosehart, or on Facebook. There's lots of ways to get a hold of me. Ravtej Singh says, does selling puts offset a bear market if you invest with margin? No, selling puts would not. Selling puts would just reduce your cost base and maybe force you to own the shares, have them put in your account. Buying puts, on the other hand, hang on, I got 1 minute, I gotta wrap up, guys. I gotta go put my daughter to bed. But buying puts would allow you to put the shares into someone else's account. If you didn't own the shares, it'd be a naked put that you'd be buying, in which case would protect a certain strike price, would protect against any downside past that strike price. So yes, buying puts on a margin portfolio would do that. Check out my Instagram where I talk about the options wheel, which involves basically selling puts till you acquire dividend companies you like, buying a diversified dividend portfolio, using selling puts to acquire them at a lower cost base, and then going in, owning those shares, levered up 3-to-1, collecting a nice healthy dividend, making 20%, then sell covered calls on that portfolio at a price you're willing to have those shares called away from you, locking in, say, a 10% gain while enjoying that nice healthy dividend, levered 3-to-1, and then using the premiums from the calls that you've sold to pay to buy puts covered on the positions that you hold that you're collecting dividends on. So if the market does pull back, because you're levered up and margined, then you would have a situation where the puts would be paying very well to cover any margin calls. If anyone can find a hole in that strategy where you're making less than 15 to 20% a year, let me know in the comments. I seriously have pitched this to everyone, and no one who follows those 4 tips can give me a situation where it isn't positive, where you can lose money. Unless you're trading on companies that don't pay good dividends, or again, the premium is really expensive for the puts. I can't see it on the portfolio I'm looking at. So let me know in the comments. Thank you all so much for watching. I don't want a haircut. I'm gonna let it grow. Just enjoy the flow, you know? It's COVID time. Having uncut hair for many, many months is now socially acceptable. I should brush it though. Do you follow the Greater Fool blog? I've heard of it, but I put that once or twice, but I don't follow it very often. Is this compound far out of your city, of your original area? No, it's literally around the block from where I live now, closer to the school and amenities, just off of Oxford in London, Ontario, and West London. So thank you all so much for watching. I really appreciate all the likes and all the feedback and all the comments, and I will see you if you're watching the replay in the comments, and next week live 7 p.m. Eastern, and on Instagram at Mike Rosehart, where I post stories 6 to 8 times a day. All right, everyone, you know this, you know the drill. Every single week for the last 3 years, this is what I say at the end of all my videos. The secret to unlocking a wealthier you is dead simple. 1, spend less. 2, earn more. And 3, maximize the returns on the difference between those two things, and you'll become wealthy and fire. All right, everyone, have a good night.